Canada's National Home Price Index has now been falling for 4 straight years, 20% below the peak set in early 2022. And yet, the headlines keep telling you the market is about to bounce back. But here is what they are not telling you. Behind those national averages, there are cities in this country where prices are not just softening, they are dropping fast. Sellers are slashing prices. Homes are sitting on the market for months. Listings are piling up, and nobody is buying. This is not some future prediction. This is happening right now in 2026. Today, we are counting down 7 Canadian cities where home prices are dropping the most. If you own property in any of these cities, you need to watch this. If you are thinking about buying, this could save you from a 30-year mistake. And if you have been told that the Canadian housing market only goes up, well, the data says something very different. Let us get into it. Number 7. Kitchener-Waterloo, Ontario. Kitchener-Waterloo sits about 100 kilometers west of Toronto, straddling the Grand River. Population of roughly 600,000. This was supposed to be Canada's tech corridor, the next Silicon Valley. Shopify, Google, a thriving university pipeline. Home prices surged on that promise. The average home price is $733,000, down 5% year over year on average prices. But the benchmark MLS Home Price Index tells a sharper story, down 8.6% according to RBC. Sales volume in 2025 dropped 8.8%. Listings jumped nearly 14%. Days on market for condos are stretching past 55 days. Major employers are shutting down and relocating operations. Property taxes in nearby Waterloo jumped 6.4% this year alone, on top of 12% the previous 2 years combined. That means the tech narrative that drove prices up is now working in reverse. If the jobs leave, the demand leaves. And if the demand leaves, prices follow. A detached home that sold for $877,000 in 2025 is expected to drop further. Some local analysts are projecting an 8 to 12% decline through 2026. Kitchener-Waterloo is a warning about what happens when a housing boom gets built on a single industry promise. But Kitchener-Waterloo is not even the biggest decline in Ontario on this list. Not even close. Number 6. Hamilton-Burlington, Ontario. Hamilton sits at the western tip of Lake Ontario, about an hour southwest of Toronto. Population of roughly 580,000. Hamilton was the original spillover market from Toronto. Affordable, close enough to commute. Steel City reinventing itself. Prices tripled in parts of the city between 2015 and 2022. Investors poured in. First-time buyers stretched their budgets to get in before they were priced out forever. The average home price is $721,000 as of March 2026. Down 8.6% year over year. Hamilton home sales in December 2025 were the slowest since 2010. That is 15 years. Inventory is elevated. Buyers are not moving. The condo segment is especially weak. That means if you bought in 2021 or 2022, you are almost certainly underwater. For investors who bought rental properties at peak prices, the math has completely broken down. Higher carrying costs on a depreciating asset. And the correction here is tracking almost identically to Toronto, just at a lower price point. We are going to take a quick break from the countdown. If you are seriously thinking about buying property in Canada or trying to figure out whether to sell before prices drop further, subscribe. I cover Canadian housing every single week with real data, not opinions. Now back to the list. Number 5. Vancouver, British Columbia. Vancouver sits on the Pacific coast, squeezed between the mountains and the ocean. Population of about 2.6 million across the metro area. For decades, Vancouver has been one of the most expensive housing markets on the planet. But right now, it is also one of the fastest declining. The benchmark home price in Metro Vancouver is $1,104,000. That's down 6.8% year over year. Detached homes are down nearly 8%. Apartments are down 7.8%. And here is the number that matters most. Active listings are sitting 38% above the 10-year average. Sales are nearly a third below the 10-year average. The sales to active listings ratio is 14.2%, barely above the 12% threshold that signals sustained downward price pressure. Over 80% of homes sold below asking price in 2025. Metro Vancouver recorded its lowest home sales in 25 years. The BC Real Estate Association expects home sales in the province to fall another 2.1% this year. Average prices province-wide are forecast to slide to $939,800. Active listings are at their highest level since 2015. Royal LePage is projecting a 3.5% decline for Greater Vancouver through the fourth quarter. That means Vancouver is not just expensive anymore. It is expensive and losing value at the same time. That is the worst combination for homeowners. You are paying premium carrying costs on a depreciating asset, and the condo segment is the weakest of all, with investors facing cash flow challenges at current rents while their units shed value month after month. Number 4. Fraser Valley, British Columbia. The Fraser Valley stretches east of Vancouver, covering Surrey, Langley, Abbotsford, and Mission. Population of roughly 2 million. The Fraser Valley was supposed to be the affordable alternative to Vancouver proper, and for a while, it was. But affordable is relative when detached homes were pushing past 1.5 million. The benchmark for a single-family detached home is $1,375,000, down 8.7% year over year. Townhomes are down 7.3%. Apartments are down 9.2%. That apartment number is worth repeating. Down 9.2%. Home prices fell for 10 consecutive months before finally showing the first monthly uptick in March. Sales are 42% below the 10-year seasonal average. That means the Fraser Valley is experiencing the sharpest correction in British Columbia. When prices fall for 10 straight months and sales are running at less than 60% of normal volume, the market is telling you something. And what it is telling you is not good news for sellers. Number 3. Greater Toronto Area. The GTA needs no introduction. 6.7 million people. The economic engine of Canada. And right now, one of the weakest housing markets in the country. The GTA benchmark home price is $941,800, down 7.4% year over year. In the city of Toronto specifically, average prices are down 7.9%. Detached homes in the city have plummeted 9.7%. Condos are down 9.6%. Active listings are near decade highs. Days on market have stretched to 47 days, up from 36 a year ago. Properties are selling for 2% below asking on average. And March 2026 recorded the weakest national resale activity in 17 years for this time of year. The condo market is the soft spot. Nearly 5,000 active condo listings against fewer than 1,000 sales per month. Pre-construction closings keep adding supply. Investor-held units face cash flow challenges at current rents. Royal LePage is forecasting a further 4.5% decline in GTA home prices through the fourth quarter. That is the biggest projected drop among all major Canadian cities. That means the largest, most liquid housing market in Canada is in a sustained correction that has now lasted 4 straight years, 20% below the 2022 peak. If you own a condo in downtown Toronto, you are sitting on a loss that is getting bigger every month, and a massive wave of mortgage renewals is hitting in 2026, which could force more financially struggling homeowners to sell, adding even more inventory to an already oversupplied market. But the GTA is not number 1 on this list. Number 2. Oakville-Milton, Ontario. Oakville-Milton sits between Toronto and Hamilton along the QEW corridor. Population of about 270,000 combined. This is one of the wealthiest suburbs in Canada. Executive homes, top-ranked schools, Lake Ontario waterfront. The kind of place where you would expect prices to hold. They did not hold. Average home prices dropped 10.1% year over year, from $1,170,000 to $1,052,000. That is a loss of over $118,000 in 12 months. To afford the average home here, you need a gross household income of approximately $217,000 a year. That means even Canada's most affluent suburbs are not immune. When prices drop 10% in a market where the average home costs over $1 million, the losses are enormous. $118,000 in equity, gone in a single year. And number 1, Powell River, British Columbia. Powell River is a small city of about 14,000 people on the Sunshine Coast of British Columbia, accessible only by ferry or floatplane, no highway connection to the mainland. For years, Powell River was a hidden gem. Retirees and remote workers priced out of Vancouver discovered it during the pandemic. A quiet coastal town with mountain views and ocean access at a fraction of Vancouver prices. Demand surged. Prices followed. A home that sold for $350,000 in 2020 was suddenly listing for $640,000. And then they crashed. Home prices in Powell River dropped 17.5% year over year, from $640,000 to $528,000. That is a loss of over $112,000 in a town of 14,000 people. The income needed to qualify for the average home dropped from approximately $120,000 to $99,000. That means Powell River is the single biggest price drop among all tracked Canadian housing markets, 17.5% in 1 year. In a town with no highway, limited job prospects, and an aging population. The pandemic brought buyers. Reality sent them away. And the sellers who stayed are watching their equity evaporate. So let us bring this full circle. Canada's housing market is not one market. It is dozens of markets moving in completely different directions. Quebec City is up over 10%. Moncton is up 11%. Regina is up 6%. But the cities on this list, concentrated in Ontario and British Columbia, are experiencing the steepest corrections in years. 4 straight years of declining national prices, 20% below the peak. 55% of all markets tracked by the National Price Index are down 10% or more from their highs. And the Terranet National Bank Index just recorded its 4th consecutive monthly decline. The bottom line. If you are a buyer in these markets, the leverage is yours. If you are a seller, the market is telling you something. And if you have been waiting for prices to bounce back to pandemic peaks, the data says you could be waiting a very long time. Drop a comment and tell me which city on this list surprised you the most. Or tell me if you own property in one of these markets and what you are seeing on the ground. Subscribe. I cover Canadian housing every single week with data, not hype. We will see you in the next one.